The housing market in the US is showing absolute major cracks. But with all of this, Jerome Powell is still refusing to cut interest rates. So, with Trump pushing him and telling everybody publicly that Jerome Powell is, quote, too late, will this cause the housing market to absolutely crash? Let's get into all of this and a little bit more about what this could potentially mean for the market and how the consumer is looking based on the housing market. But first, we are seeing some of the most volatile markets in the US absolutely show huge crashes. See, I'm sitting here in Tampa, Florida. That is the number 2 biggest drop in all of the metro markets after Austin, Texas, my hometown where I grew up. For comparison, half of the top 50 metros saw year-over-year housing decline, and in May and April there was 22 and 20 major metros. So only 7 of the 50 largest metros saw it in November. So more and more of these metros across the United States are starting to show housing cracks. And it's just because of the massive amounts of inflation. It's also because of the mortgage rates absolutely skyrocketing in flight and seeing them take a major, major hit to the overall market. So housing market faces red alert as mortgage rates near 7%. Moody's Mark Zandi upgraded the housing market and mortgage rates, saying there's red flare, citing 7% mortgage rates as a major threat to sales and buildings. High rates drive down demand, obviously, as many of you guys know, and the supply pressure is growing as listings rise and delistings rise 47%. So more of that, nearly 1/3 of all major U.S. housing markets now see housing prices fall, and this is from there. So not only do the top 50 metros see a decline, 1/3 of all markets are seeing this major decline. So this seems like it's a slow, gradual decline, but as much as we saw the housing market absolutely explode within the past couple of years, of course, because of the low interest rate environment and the massive amounts of inflation that we saw, well, not so fast, my friends. We're seeing this all come crashing back down, crashing to reality. So prices are set to see big gains in the Northeast and Midwest, but nearly 1/3 of the largest 100 markets are now showing annual price decline, according to ICE, a mortgage technology firm. Funny acronym there, especially with everything we've got going on. But housing prices prediction. When will housing prices drop? The much anticipated spring home buying season never bloomed. In truth, it hardly even budded. Now, housing market stakeholders are looking for a summer for potential rebound, hoping that growing inventory and slower house price appreciation will entice buyers. But we're not seeing that because mortgage rates and refinance interest rates today are at a 6.72%. And these 20-year fixed inched past that 4 basis points, 15 at 5.9%. So mortgage bankers and the 30-year fixed is not expected to decline as much as people are thinking. And with that, right, Jerome Powell would cut interest rates, right? No, not so fast. Jerome Powell, or as Donald Trump is calling him, Jerome Too Late Powell, is refusing to cut interest rates during this time. So with interest rates now at a relatively high mark comparatively to where they were 5-6 years ago when they were at nearly 0%, well, without him cutting interest rates, we're going to have some cracks in a lot of the asset market. Excuse me. And some of these asset markets include the housing market because now interest rates are going to be very high. So interest rates being high means, hey, what else are we going to see, right? We're going to see the 5-year housing market prediction. We're seeing 5 years, the building's going to be slower because now, not only that, we've had low inventory in a lot of places. People are refusing to sell their homes and get out of it. So if they're refusing to sell their homes and move and get out of these mortgages that are nearly all under 4%, because one, interest rates are still very high, and two, there just isn't enough housing appreciation to justify moving. Well, we're going to see a massive amounts of slowdown, and that's where I think these key takeaways are coming in, right? Sales of existing home will grow moderately, that's what they say, as a lock-in effect of low mortgage rates for current homeowners begin to wane. But affordability will remain a significant challenge, especially for first-time buyers. Although newly built homes will continue to fill in supply gaps in certain markets, more sellers decide to list their homes. Builders will face more competition. The days of comprehensive real estate strategies on consumer-friendly portals such as Zillow or Realtor may be numbered. Instead, buyers may have to visit multiple websites or real estate offices to compete, and mortgage rates will likely range from 6 to 7% unless there is a recession, but short-term lending rates could fall more quickly in late 25 or early 26. So as I said, with this, right? How do interest rates basically react with mortgage rates, right? Lowering interest rates generally lead to lower mortgage rates, making borrowing for more affordable. This happens because the Fed actions influence the cost of borrowing for banks, and those changes often get passed on to the consumer in the form of low interest. So the Fed lowering the Fed funds rate and the interest rates would in turn allow the banks to lower lower mortgage rates. But Jerome Powell, as I showed you guys earlier, well, he's not going to cut interest rates here. We've got 9 days, 10 days until that decision. And it's at 4.7% chance that he's going to cut interest rates. So look, I'm not a betting man, but it seems like a safe bet to say that that is not going to happen. And why is he refusing to cut interest rates? Well, we've got the Dixie sitting here, right? So the Dixie looks at the strength of the dollar. It's at 98.4, which is a little bit better than we've been seeing tracking it here on this channel. You guys know I'm always going back and forth looking at these kind of things. So it is a positive to see it start to tick in an upward direction. But the issue is that there is some sort of problem here. I mean, there's a bunch of inflation going on, right? Everybody's flocking to assets except for the housing market. They're looking for more liquid assets. So we're seeing the stock market not do too bad. Look, 6.67%. The average S&P 500 return in 2010 to 2020, right? They were expecting, hey, 8 to 12%. That's what they were saying. We're a little over halfway through the year, nearly through 7 months, and we're at 6.6%, right? So you could see that number start to tick up, and I think more people are going to flock to more liquid assets like stocks, like Bitcoin and others, because these things are just real estate's not being as advantageous. It's not as much of a sure bet home run that we were seeing previously, right? The cracks are beginning to show. Miami, Dallas, and Orlando, all of them. All of these markets that we saw boom from the COVID pandemic are now starting to show a lot of cracks. And so I think this is something to deeply monitor, because not only are we seeing that, right, we're seeing the consumer. So if we look at consumer strength, how it's doing, well, the consumer spending has gone down. And majority of people in the US hold their wealth in their houses or their mortgages. That's their biggest purchase. It's usually, the American dream. Hold a house or own a house, white picket fence. So if that's the case and housing prices are not booming, right? Majority of people are losing massive amounts of their spending power. So if they're losing their spending power and then they're not spending, and we have the number one consumer economy in the world, well, this is all a recipe for the overall economy to not be doing as good as people may think it should be doing. And so I'm going to be monitoring this housing market very closely because I've been calling it on this channel for quite some time that I think that the housing market is going to be the one that's going to be showing the most negative effects here this year. And we're already starting to see that, right? I mean, some of the fastest growing markets are now down 5% year over year. Now, you don't really see housing prices go down this much like we really anticipate seeing, So even though we're in strong markets, excuse me, like Tampa and Austin that have seen massive amounts of growth when it comes to job growth. And if you look at, every other metric under the sun, these places all should be pumping along. But it's interesting that these two markets are two of the leaders in seeing negative housing growth. And this is something that I think we should keep a very close eye on going forward, especially with this interest rates and the debacle going back and forth between Trump, especially when we have Plute, who is the guy for Fannie and Freddie Mae, who is literally openly going at Jerome Powell. He's just coming out and saying all these different things about how they're filing for. He's going at Jerome Powell, going for the weakness of the Fed, right? He's saying all of these crazy things, saying Jerome Powell is the worst Federal Reserve chairman in history. They're calling him a criminal. Plute is going on and on and on and just retweeting that he's considering resigning. He thinks that mortgage spreads are better under President Trump than Biden, but Fed Jerome Powell looks to be resigning, or at least that's what Plute is all here saying. So he's going on and just going in on this guy. He's even having a bunch of different people go in and say he's a criminal. Look at this. He's got 23 members of Congress to allow rent payments counting for mortgages. Okay, that's not the right tweet that I was looking for. He was looking at Jerome Powell resigning would be a good thing for America. So he's just going in, and he's the chairman of Freddie Mae and Fannie Mae. So director of federal housing. 3 million followers on X, and he's just openly just going at this guy. So the political theater around the housing market, well, I mean, is one thing, but the results speak for themselves. When you see a giant decline like this, it's not good. When you see half of the biggest major metros in the United States showing negative growth, it's not good. When you see 1/3 of overall markets in the United States showing negative growth, it's not good. So overall, the housing market is in a very shaky place. So we need to keep a very close eye on what is going on here, because this is a big driver for the entire economy. Now, I know 90% of you guys that keep coming back are not subscribed. I'm really working hard to try to get to 1K subscribers as quickly as possible. So please hit that subscribe button for me, guys, and hit that bell notification so you guys know when I'm going live. I would love to hear some of your comments live here in the chat while I'm going back and forth with this. And make sure you guys are hitting that like button too, because in just under 10 days, we're going to see just how quickly things can change, whether or not Jerome Powell is going to cut interest rates or not. I'm thinking that he's not going to, but that pressure, the pressure cooker of Donald Trump and Bill Plute coming at him, well, that's going to be adding up to more and more political theater. So stay tuned. And make sure you guys are hitting that subscribe button, that like button. And I'll see you guys all at the next one.